Okay, folks, so we got to talk about what is coming tomorrow and what you need to know before it does. And then I want to give a violent update on what a specific well-known analyst said about one of our high conviction plays and my reaction to it. And the only thing that I ask in return for all of this is that you hit that ravishing like button, and also don't forget to subscribe either. Also, prices on ZipTrader U will be going up tomorrow for the first time since launch. So if you do want to lock in lifetime access for the current one-time fee, make sure to check it out below. Coupon code BlackFriday100 will be over as well after tomorrow. Okay, folks, so fear was back today. Whether we're talking about the S&P, the NASDAQ, the Roskies, the crypto market, lots of panic today towards close. You also have the VIX Fear Index up 8%. And why is this? Well, because of the CPI index coming out tomorrow. Why does the market bounce rapidly all week and then sell off in anticipation of a report that we knew was going to come out for months? Well, because quite simply, you have a lot of institutional traders that make money by buying and selling volatility. And many of them algorithmically trade and anticipate fear around specific catalysts, which means that even though they made tons of money just cycling in after the massive dip we had last week, the algorithm may now see it fit to start instituting selling pressure and start pushing bearish positions in anticipation of others doing the same ahead of the report. If the algorithm is anticipating uncertainty, what is the algorithm thinking? It's like, okay, well, hey, let's sell before the uncertainty, ride the bearish trend, and then when we get the next trend, we can then go and accelerate that one as well and make tons of money on both sides of the move. That's why so many times you'll see insane selling pressure right up to a CPI index report, and then even if the CPI index report is bad, if there's just a little bit of green, you'll see massive buying pressure, and it'll just keep bouncing. Trading algorithms are programmed not to care about the fundamentals of the market. They don't give a shite about that. They just care about what people are speculating on and accelerating those speculations, which is why you see such dramatic trading when it comes down to an entire market that all of a sudden went risk off huge for 2 weeks and then all of a sudden went hugely risk on. And of course, after a few cycles of predictable trading, one algorithm decides, hey, wait a second, well, we know how all the other algorithms are trading. Let's go ahead and do the opposite so we can make money. And then all of a sudden it creates this wave where all the other algorithms start catching on and they start doing the same, and then you have the opposite cycle. But outside of that, what's really fascinating and what's really important to understand is the market's made of really just two different parties. You have the foundation, those who are buying and holding equities. Then you have the top layer, which are the short-term traders, those who speculate, those who profit off short-term fear cycles, those who hedge, those who algorithmically trade, and overall just those who are exploiting those short-term cycles. The funny thing is that when you look at these numbers day by day in terms of how the indices are moving or even how your individual stocks are moving, they're not moving based on what the foundation is doing, which are people who are actually buying based on the fundamentals. They're moving based on what the traders are doing. Oftentimes people think they're looking at the true value of something, but they're really just looking at the top layer of something that is on top of the foundation of what the true value is. When you look at a stock price, you can't see where the foundation traders are. You can only see that top layer of the speculators who are bidding things up to euphoric highs to fit their agenda, and also killing them back to the foundation to fit their agenda as well, and sometimes inducing some of the foundation traders to sell by pumping out really negative PR pieces. Of course, the foundation changes over time, but it's very difficult when you look at a market to see how much money is really in that for the long term and how much money is in it just to profit off the cycles. Foundational investors, whether institutional or retail, that have a target date of say 5-10 years, aren't going and dumping tons of equities after buying them earlier this week just because we have an inflation report coming that we've known was going to come for months. It's really just the traders exploiting the moves. Now, on this channel, of course, we talk about both short-term trades on these cycles and also long-term high-conviction trades or really investing. But it's important to understand the difference between these two because a lot of people screw themselves up thinking, oh no, the fundamentals of the entire market changed because of one report, or oh no, this company has great fundamentals because it just went up 500% in a day. No, there's people that are just trading off the speculation and the cycles and using that to fit their agenda. And there's also people in the long run who are like, okay, well, I have a high target date. I don't really give a shite if people sell out now or buy up later. I just care about what the company is doing in the long run. And you have to curtail your mindset based on which type of position you're targeting, if that makes sense. But anyways, tomorrow, the next CPI index report will be out, and the Biden administration has signaled that the data could be high. I could totally see the conversation he had with his advisors. Mr. President, everybody knows that inflation is going to be hot again this month. So maybe if we just come out and simply say that it's going to be hot a couple days before the actual report, blast everybody with headlines, then we can control the conversation and people will think, oh, hey, he's on it. He knew it was going to be hot. Maybe they'll even be less likely to blame us. And then he's just like, yes, that's a great idea. Who is this again? Is that you, Hunter? I'm just messing around, but I feel like that's how political PR goes these days. That said, a lot of inflationary pressures are global and are outside of our government's control. A lot of massive supply chain shortages all around the world. But I did make a recent video talking about each of the different issues and then ways that our government could help control the inflation problem without dramatically tightening monetary policy. And some of those ideas actually involve strategically helping push the supply chain along. So yes, we have supply chain shortages, but there's things that we can do to help fix those from a government standpoint. And unfortunately, a lot of these solutions coincide with issues that are along political lines, so they're very, very difficult to get done. There's a balance between the squeeze of inflation and the squeeze of temporary setbacks in terms of policy. And I think that unfortunately, a lot of these issues are very, very political. And in that sense, honestly, it's probably easier to reappoint a Federal Reserve chairman who will coincidentally change his stance to being more hawkish on monetary policy right after getting confirmed for a second term. But anyways, what you want to pay very, very close attention to in this report is energy, because that was the biggest driver of the last report. We had a disastrous October, plus 4.8% in energy as a whole, plus 6.1% in gasoline costs, and fuel oil ranking in at a horrendous 12.3%. All of these things contribute to pricing pressures everywhere else. You look at crude oil prices from November 1st to November 30th, they pretty much consistently trended down from October, but it was still high enough to motivate more pricing pressures for November, which you'll see tomorrow. But in December, it really tanked amidst variant concerns. And most energy prices look the same way. Now keep in mind that when you're looking at the CPI index tomorrow, you're looking at November, but also some of the delayed effects from, say, higher transportation costs in October and overall energy costs that have just started going down. So it should still be hot, but hopefully we see some relief from the energy segment in December and January. Okay, lastly, so JP Morgan came out this morning and said they see this one EV play that could surge more than 60%. And what is it? Well, it's our very own EVgo. And they actually set their price target exactly to the same number as our ZipTrader U price target, which I was very happy to see. CNBC reports they said, as electric vehicles grow in popularity, JP Morgan is bullish on fast charging services and highlighted one provider it says will outperform. JP Morgan said, we see compelling use case for fast charging, especially in the retail and fleet segments where the company has strong and growing partnerships, and we expect the company to benefit from the rapid growth of the overall EV market over the mid and long term. Now again, what is the edge that EVgo has over some of its competitors like our very own ChargePoint? Well, the main difference is that EVgo is the leader in fast charging solutions. It's the largest public fast charging network in the US. What does fast mean, Charlie? I know it's the opposite of slow, but to what degree? Well, EVgo specializes in DC fast charging, which compared to the industry standard level 2 and at-home regular outlet-based charging with level 1, it substantially decreases charge time, cutting charging time down to mere fractions of what it would be with the other two solutions, which obviously in the long run is where the industry is heading. In the future, we are going to be in this environment where EVs are no longer a luxury, but rather a more economical and practical option. Battery range will probably be somewhere like 1,000 miles. Cars will be cheaper than gasoline cars, better performance than gasoline cars, although some already do. But the final touch is that convenience factor of charging. And obviously you can charge from your apartment or your home, but in terms of a long road trip or when you're out and about and you didn't charge your damn battery, well, the convenience factor is how fast you can get a charge. And DC charging stations are the next gen, which provides a big stepping stone to that goal. And I would almost argue when you get to a point where battery ranges are like 1,000 miles plus, and most people don't travel more than like 20 or 30 miles a day, and even the biggest road trippers aren't taking 1,000 plus miles a day, well, I'd almost argue that charging stations are going to be a lot more applicable to fleets. Fleets like trucks that are logistically driving around the entire country. Ones that have maybe 2 drivers, one that drives for 10 hours or whatever the regulation is, and then the other that drives for the next 10 hours. Those are the ones that would run out of range at even 1,000 miles, and those are the ones that would need very, very fast charging stations in order to, well, recharge their vehicles so they can be on the road for as much as possible. And when you look at it from the fleet angle, you start realizing, hey, EVgo makes a lot of sense. It has one of the biggest advantages, which is being a leader in fast charging. Now, it has a disadvantage in that it doesn't show as much proof of concept in the present day as something like a ChargePoint, which is the leader in current generation charging stations, which is also pushing into fast charging stations as well. But the plus is it is leading in that next gen version. So I think that both make a lot of sense. Went on to say, we anticipate the company driving outsized revenue growth on rapidly increasing fleet adoption and higher utilization. Strong industry partnerships help reinforce EVgo's reputation and customer acquisition approach with increased exposure. What industry partnerships are they talking about? Well, they have partnerships or relationships with companies like Uber, Lyft, GM, Avis, and Budget Rental Car, BMW, Nissan, Tesla, and many state governments. They even notably have a partnership with Chevron, where they will be installing fast chargers at some Chevron filling stations. It makes a lot of sense. If you're a gas station, you'll want to diversify your revenue streams because in about 10 to 15 years, your numbers are going to be way different. Plus, JP Morgan believes EVgo has a lot of room to improve its margins through software initiatives and by working with governments and utility providers to negotiate more competitive energy rates. That reminds me also, ChargePoint has a much bigger edge in terms of software. So EVgo really, I would argue, is mostly a tech fast charging station play, and ChargePoint is more of a proof of concept in the moment, massive leader play. I think that ChargePoint is probably the safer play, but EVgo, based on the technology, may end up actually being a lot more profitable over the long run. But both are good plays in my view. But anyways, pretty excited to see this analyst coverage. Analysts don't always get it right, and a lot of them still hate on EVs. But when they do get it right, we definitely got to recognize them for it. Anyways, that caps off this video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. Tomorrow is our last day before we raise the price of ZipTrader U for the first time since launch, so if you do want to get $100 off at the current price, make sure to check it out before the sale ends tomorrow. Anyways, that caps off this video. Have a good one, and I'll see you tomorrow.